So, in reading a lot, studying a lot, and talking to a lot of people, I feel like there's two real basic camps of folks out there right now. So, you've got the side that says, "Hey, we haven't even hit a recession yet, and inflation's still terrible, and the yield curve inversion. This market's going to go nowhere but down." And then you've got the other side that says, hey, this thing's almost over. We've already had the big drop last year. Very, very rarely does the market drop 2 years in a row. Yes, we're going to have volatility, but the worst is behind us, and we've got nothing. We've got lots of opportunity to the upside. So, I can see both sides' perspectives, but we're going to unpack that from a technical standpoint today. So stick with me. My name is Brian Cannon. Welcome to Markets in 5. If you've watched Markets in 5, you're familiar with this chart, but essentially the S&P has been knocking on the door of resistance multiple times, and recently just can't seem to get above that level. So again, the more times resistance is touched, the more importance that resistance line has. So when it breaks it, it's a significant sign to traders. So we've got to be aware of that. And here in the pink, we're starting to coil up a little bit. So you can see that we're having higher high, or we're having lower highs and higher lows. So it kind of, to me, it's like a spring. You coil, and you let it go, and it pops, and it's either going to pop up or it's going to pop down. So that's kind of what's happening here. Is it's coiling up in this area between this resistance and this shorter term trend. And so the pink line represents some possibilities, right? It could just bounce in this area a little bit more, and then either break up or break down. So if it breaks up, obviously you would want to reduce the levels of cash and pick up more equities. And if it breaks down, then you're pretty happy sitting on some cash and may raise some more. So in this chart is two potential scenarios where what we could see happening here with the S&P. So again, it's the same chart, just gives us a little bit more room to illustrate some ideas. So here we are in the orange line right here. And so again, if we continue this coil up and eventually break to the upside, usually, again, when you break to the upside, you're going to hit some sort of resistance. And we've got a couple of lines there highlighted. And then you'll usually come down, especially with a line this important, that's been touched so many times, it'll usually come down and test as a support. If it holds and takes back off, that's a very, very bullish sign. And we would basically have no more cash at that point. However, if it rolls around and breaks to the downside at some point, it'll usually come up and retest, either this this uptrend line or this downtrend line. And then if it can't hold that and break through it, and it breaks down, then that would be a very bearish breakdown. That would be a very bad sign. So, obviously having cash and raising cash would be the idea at that point. Now, when we look at the Nasdaq, for instance, we're starting to see some signs of life, kind of like the charts on the S&P. You're starting to see it knock at resistance. So, are we through this thing? I mean, I don't know. It's hard to tell, but the stock market is a futures marketplace, so it will price something 3 months out or 6 months out. So that's where you can have a company that does really good earnings and blows it out, but then they'll say, but this quarter might not be that good, and you'll see the stock get punished. So the stock market is a futures market. So if it starts to sense that inflation is tailing off, and that things will improve, and corporations are shoring up their balance sheets by laying people off and things like that. I know it doesn't sound good to you and me, but at the same time, it's good for the shareholders. So those types of things can be viewed as positive for the stock market. So but if we look at the Nasdaq here, and you have this, this is going back to 2020. So the rise right before the drop in the pandemic drop. Well, you had less and less companies kind of participating in that rise, and so that's what's called a kind of a negative or bearish divergence, right? So the stock's going up, but the participation rates are going down. Well, right now we're starting to see participation rates rise, and we're starting to, to a market that hasn't caught up. So this is more of a bullish divergence. So there's some positive things popping through this thing. So we're watching all this stuff very closely, regardless of which camp you're in, whether you feel like the worst is to come or the worst is behind us. The price action is the reality of the market. And so if it's breaking out and running, and we're starting to see a few signs of that, then, you've got to participate. You've got to have a dog in the fight. But if it breaks back down and goes back down in the channel and heads lower, obviously you need to take the risk back off. It's not worth it at this point. So we're watching things very closely. It's going to be interesting year for sure. But I think the important thing is to know that, eventually, whether it be now or in 6 months, it's going to be an amazing buying opportunity. So, the key is just hanging in there and being able to deploy that cash when the time is right. So if you have any questions, give me a shout. I'll see you on the next Markets in 5.